Bill Hickerson here in the Illinois office of Advanced Capital, and just want to talk to you a bit about Roth IRA conversions and backdoor Roth IRA contributions and some of the pitfalls that you should be aware of. But first of all, Roth IRAs are a fantastic way to save for retirement. Money grows tax-free. Qualified distributions come out tax-free. There's no required minimum distributions at the age of 72 like there is with a traditional IRA. Your beneficiaries receive your assets free of tax as well. And the list goes on regarding the benefits of a Roth IRA. So a backdoor Roth IRA contribution, first of all, why would you do that? You do that because your income is too high and you couldn't make a contribution directly to a Roth IRA. So the process is you make a contribution to a traditional IRA. So say you put $6,000 of after-tax money into a traditional IRA, and then you convert it right away into a Roth IRA. So there's been no growth of that money. So in theory, there's going to be then no tax on the conversion. So if you had no other traditional IRAs, that's probably going to be the case. But the IRS has what they call this pro rata rule that you need to know when making these conversions. And basically what it says is you have to take all traditional IRAs into account in determining how much of that conversion is free of tax. So let's say, for example, you had $94,000 in a traditional IRA that you had rolled over from a previous employer. So it's all pre-tax money. None of it had ever been taxed. And then you made this $6,000 contribution to the traditional IRA to convert. So in the IRS's eyes, you now have $100,000 in a traditional IRA, of which $6,000 has already been taxed. So 6% of the total is free of tax. So then when you convert that $6,000 in from a traditional into the Roth IRA, in this backdoor Roth IRA contribution, only 6% of it can convert free of tax, or $360 of that $6,000 converts tax-free. The rest will be considered income when you file your taxes. So many people have been surprised when they file their taxes and weren't aware of that pro rata rule. So a couple other things to be aware of. For qualified distributions, the IRS has what they call a 5-year rule for Roth IRAs. For contributions, that 5-year rule starts the day you make your first contribution to a Roth IRA. It needs to be in there for 5 years for your distributions to be considered qualified. And any subsequent contributions you make, you just go back to that first day, the date you made your first contribution to a Roth IRA. Conversions are done a little bit differently. Every conversion that you make has its own 5-year window that needs to be satisfied. So a little bit different. Contributions, there's essentially one date you start with. Conversions, each conversion has its own 5-year window. There also can be some other tax surprises down the road. Say, for example, you're 65 and you're taking Medicare. If you convert money from a traditional to a Roth IRA, that's going to increase your income for purposes of figuring out what your premium is for Medicare. So I've seen people convert a whole bunch of money from a traditional to a Roth IRA, increase their income to the point where it increased their monthly premium for their Medicare as well. So again, just things you need to be made aware of when making these conversions from a traditional to a Roth IRA. Again, Roth IRAs are a great way to save for retirement and fund your retirement as well. But just need to be made aware of all the rules that surrounds them. If you have any questions, please don't hesitate to reach out. Be happy to help. Thanks.